hot debate, which has in fact always been the debate, is whether to choose between a government bond or an FD, and where are the returns better, what are the taxations looking like, etc. And we're going to discuss this with Lakshmi Iyer, who's the Group President of Investments and CEO of Bajaj Alternate Investment Management Limited, joining us now. Lakshmi, hi. Thank you so much for taking out the time and joining us. My first question to you is, if somebody who is not invested in government bonds at all, and if you would want to suggest the person to go ahead and invest in the bonds, what will be the aspects that you would be looking at, and versus an FD, how will you stack up a government bond?
Sure thing. I think first and foremost, the most important consideration that he or she should keep in mind while investing in Government of India securities, that it is a sovereign risk. What does sovereign risk mean? You do not have to risk your loss of capital. I think that is the first and foremost consideration, which paves way for investors, including retail investors, to look at an instrument like this for investments. The second most important thing one needs to keep in mind is that when you are making an investment in government securities or government bonds, it is subject to the market fluctuations, in the sense that if you buy the bond today, and if there is a movement in interest rates, the reflection of that happens in the prices. So accordingly, that is called the mark-to-market risk. However, if you are holding this to maturity, you do not have to worry about that. It is very similar to the fixed deposit that you invest or that you make your investments into. So I think these are the two most important considerations. And last but not the least, Government of India bonds are liquid. There is a vibrant secondary market where you can enter in and exit out. So that is the, I would say, biggest advantage that you have when you make investments in government bonds.
Makes sense, Lakshmi. And how about the returns? How would you compare returns between a government bond and an FD?
So there is no cookie cutter approach to this, because it depends on which tenure or which maturity that you are investing these bonds into. Typically, when investors do fixed deposits in banks, it is usually for anywhere between 1 to 5 years. Now, in that bucket, if you see the Government of India securities, today the 10-year Government of India bond is yielding closer to 6.5%. Now, this pays you coupon twice in a year. And therefore, if you annualize this rate of interest or this coupon or this yield that you are getting, the yield goes up by another 15 to 20 basis points, or 0.2% in this case. So I would say, given where we are in terms of interest rate scenario and the expectation that there is a reasonable chance that yields will come down in the coming quarters, you are better off buying a bond like this, or maybe quasi-government bonds like these, and running them for the next 2 to 3 years. The potential of it yielding you better than fixed deposits in today's market scenario is pretty high.
And since you mentioned that, considering the current scenario, can you help our viewers with a perspective as to what factors from a macro perspective govern these bond yields?
The first and foremost is the assessment of growth, which starts from the global growth and then percolates down to India growth. Are we at a very torrential or a very, very fast-paced growth scenario globally? The answer is no. So typically, when the growth globally, as also in India, tends to, I would say, remain constant or slow down a little bit, it is favorable for interest rates. So that is one. So which means expectation of lower growth is equal to expectation of lower interest rates, point number one. Second is inflation outlook. The more you are, I would say, expecting inflation to come down, again, I'm talking about India, same is true for the globe, the expectation of lower inflation fuels an expectation of lower interest rates. So again, there is a direct positive correlation. So these are the two key factors that one tends to observe. And liquidity, the higher the liquidity, if there is more money in the banking system, the rates tend to be lower. So that is an inverse correlation. So these are the three macro plus micro factors that investors definitely should consider before making investments.
Interesting. And, both are seen as safe, but do you think that one of these is safer than the other?
In terms of certainty, if you want an assured rate of interest, then nothing beats the fixed deposits. But if you are willing to subject your investments to a little bit of market fluctuation, not really impacting your capital. Is the capital at risk? The answer is no. Is there going to be volatility in your investments? The answer is yes. So, therefore, I'd say that from a risk reward trade off, in today's market scenario, you are better off putting in your money in direct government bonds, or, as I said, quasi bonds or corporate bonds, as the case may be.
Okay. And with regards to the tax angle, how are these two taxed? Is there separate provisions? And considering the taxation point of view, because at the end of the day, it's going to be taxed in the hands of the investor, right? So then, removing that, what is the kind of returns that you expect from both of these?
No, so I'd say, you know what, there are gilt funds, for example, in the industry, which are offered by mutual funds, which do exactly the same thing for the retail investor, which is buy these Government of India securities. And there, of course, you are in a pooled vehicle. So this is one of the very attractive ways of investing, assuming everything remains constant. Do these funds which participate in guilds, or as I said, if you are the know-it-all investor, you can go directly. I would say, irrespective of the taxation, what you need to look at is what is the cycle of interest rate that we are in today, and can you be reasonably confident of doing or achieving at least a 0.5% post-tax over a bank fixed deposit. At least in today's interest rate scenario, that is looking doable. It's not extremely impossible. But as I said, the caveat here being everything remaining constant, your portfolio or your investment will be subject to a mark-to-market fluctuation, which is what we call the interest rate risk.
Okay. And what is the accessibility like when it comes to these government bonds? I mean, if you can lay down a step-by-step process for our viewers, if they want to go ahead and buy these, corporate bonds or quasi bonds, what should be the ideal process of making an investment into bonds?
So there are two ways to do this. If you are the IKEA DIY or do it yourself investor kind of mindset, then you have RBI's facility of making these government bonds available for retail participation. So you can participate through that. There is an account opening process which you need to follow. For everyone else, I think there is a mutual fund route which is so beautiful, which is available for all of us as retail investors to participate in two forms. One is put in as low as a minimum of 5,000 rupees, or you can do a systematic investment plan. It is typically recommended or suggested that you follow the lump sum investment, usually in fixed income or in these kind of mutual fund avenues. But yes, the Government of India participation can definitely happen through both direct route, which is available through Reserve Bank of India route, or through the gilt route. Both of them are absolutely okay and easy forms of investments for all of us.
And Lakshmi, is there any risk of capital loss on these government bonds despite of them being risk-free?
No, it is serviced by the Government of India. So it is the sovereign risk, as I mentioned to you. As you go down the rating curve and when you flip these investments into corporate bonds, which are issued by corporates or private sector entities in India, that is when the layering or the intensity of the risk on the credit side also starts materializing. Typically in AAA, it is considered the least credit risk. And as you go down the credit rating curve, you are adding more credit risk to your portfolio. But in Government of India securities, that is not applicable.
Okay, now you already mentioned that this is the right time to go ahead and invest in bonds. My question to you would be, if there is somebody who's already invested in FDs and their FD is maturing, do you think it's time to shift from an FD to a government bond? I mean, is that the right thing to do per se for investors whose FD is maturing?
Today's market scenario, I would definitely consider one to look at, actively evaluate a switch option. And I mentioned to you the reason. The banking system is reasonably flush with liquidity today. And remember what I said earlier, the more the liquidity, rates tend to head lower, and therefore it is highly unlikely that the rates at which you had locked in your previous fixed deposit, it is very unlikely that you will get similar rates right now for the same maturity. So you could be better off evaluating an opportunity in doing a gilt or a government bond fund or investing directly. Both the options are absolutely kosher and available for all of us today.
And one last question to you. What would be the right portfolio fit when it comes to these government bonds? What percentage of the total portfolio should be a part of the government bonds?
I'd say if you are, actually flipping your FD money, can you theoretically put the entire, whatever your FD kitty was, can you put that into government bonds? The answer is a definite resounding yes. You get the additional benefit of liquidity, which is not really available in fixed deposit. Of course, there is breakage, etc. possible, some of them with a penalty, some of them without a penalty. But I'd say that this is a very seamless way of owning, and unfortunately, and good you brought this point out, unfortunately, it is lesser known. So I think the more it starts getting propagated, the more you'll find takers, but you have to withstand the interest rate risk. But as I said, if you are an FD mindset investor and holding this to maturity, then you don't have to worry about that as well.
But just want to understand. For example, if somebody is building a portfolio and wants to diversify, what percentage of their total portfolio should be in bonds?
I would say that even if you're building a 100%, say, a debt portfolio, you can have even up to 50% of your allocation into these kind of strategies. And the remainder of 50% could be a combination of corporate bonds, maybe selectively FDs, which could be probably, even in fixed deposits, you have NBFC FDs of good quality credit, which tend to offer a higher rate of interest. So a combination of that could be the balance 50% of your portfolio, which will also help you to augment the yield. And at the same time, it will give you reasonable certainty of your income. So I think these combinations in whatever form and shape, depending on your risk appetite, can certainly be used.
All right, that makes sense, and that, by the way, viewers, should be your total part. The division that Lakshmi talked about should be your division in your fixed income part of your portfolio. Keep that in mind. All right, Lakshmi, thank you so much for giving us those insights. In fact, I'm sure that this was very helpful to our viewers who are looking to invest in government bonds. And thank you so much for taking our time and speaking with us at NDTV Profit.